Today, we will talk about top 10 stocks to buy for 2024. The stock market had a solid rally in the first quarter of 2024. While investors look for bright spots after a difficult 2024, there are some troubling warning signs for the market. Inflation is elevated. The Federal Reserve continues to raise interest rates, and the regional banking crisis has caused significant uncertainty in the financial sector. All this leads to the idea that investors should remain cautious in 2024 given the challenging macroeconomic conditions. 1. Verizon Communications Incorporated, BZD. Verizon is one of the 3 largest U.S. wireless carriers. Investors have long counted on these blue-chip firms for steady income streams. Rival AT&T Incorporated, T, shocked investors with a dividend cut following its unsuccessful Time Warner acquisition attempt. But investors have overly punished Verizon in the aftermath. It's true that the telecom industry faces challenges with rising competition and a heavy investment cycle to deploy 5G technology. Verizon retains strong cash flow, however, and telecom is a nearly recession-proof industry. For now, shares still trade for less than 9 times forward earnings. 2. International Business Machines Corp., IBM. Investors have long shied away from IBM. As cloud computing took off, it seemed like IBM might get left behind. Indeed, the company had its challenges transitioning from its legacy hardware business to become better positioned for today's opportunities. IBM has started to make big changes, one example being its 2021 spin-off of Kyndryl Holdings Incorporated, KD, which got rid of the slowest-moving part of its business. Meanwhile, IBM's bold acquisition of enterprise software firm Red Hat gave it a leg up in the cloud business, specifically as it relates to virtual machines and data centers. 3. Digital Realty Trust Incorporated, DLR. Digital Realty Trust is a real estate investment trust, or REIT, in the data center and communication equipment category. Historically, Digital Realty has enjoyed tremendous growth as companies have deployed tons of additional servers to meet the sharply rising demand for data. In recent years, Digital Realty has faced some risk as some of the large tech firms have built their own data centers rather than renting from vendors like Digital Realty. Regardless, the world of data continues its exponential growth, and that gives room for the data center REITs to expand. 4. Hawaiian Electric Industries Incorporated, HE. While the stock market enjoyed a strong start to 2024, not all industries have participated. Utilities, for example, have underperformed due to concerns around interest rates and rising debt service costs. For example, Hawaiian Electric shares are down 6.6% year-to-date through April 6, offering a discount on this regional utility. Hawaiian Electric is the largest listed company in Hawaii, and it has a near monopoly on power, serving 95% of the state's residents. 5. Dominion Energy Incorporated, D. Dominion is another utility that is currently out of favor. Remarkably enough, shares have dropped more than 30% over the past year, a massive move for the utility industry, and an overreaction that dividend investors can benefit from. Dominion sells power to roughly 7 million customers in 16 states. The firm made a large and controversial acquisition, buying Scanacorp in 2019. More recently, Dominion has projected huge spending in regulated investments with a focus on low-carbon generation. Changes in the Virginia regulatory environment could also hamper Dominion's returns on future investment in that state. It's understandable why some investors are nervous. 6. Toronto Dominion Bank, TD. Toronto Dominion Bank is one of Canada's largest banks. It has extensive operations in both investment and retail banking. In recent years, it has moved into the American market as well. TD stock has slumped in recent weeks thanks to the crisis in the banking sector. TD is directly involved, to an extent, since it owns 12% of Charles Schwab Corp. SCHW. Schwab shares have plummeted over the past month amid the banking crisis. TD stock offers investors a safer way to profit from the eventual recovery in Schwab, assuming it bounces back. 7. Amgen Incorporated, AMGN. Amgen is a large biotech company with an extensive array of Food and Drug Administration approved medicines. Traditionally, Amgen is focused on therapies for cancer, inflammatory issues, and renal disease, among other conditions. The company faces some challenges as several of its drugs approach the end of their patent protection period. However, Amgen is addressing these issues via mergers and acquisitions. It bought Onyx Pharmaceuticals to add to its oncology portfolio. 8. Avalon Bay Communities Incorporated, AVB. Avalon Bay is a REIT that owns apartment buildings, and it operates more than 82,000 units, with another 5,000 in development. The firm is focused on top-tier markets such as Washington, D.C. and New York, which tend to have higher rents and stable demand. Avalon Bay was a big winner over the past couple of years, as rents surged amid the current inflationary wave. Now, however, with the housing market rolling over, investors are worried that rent growth may dry up as well. Avalon Bay will likely also have to pay higher interest rates on its debt given current market conditions. Regardless, with shares down more than 30% over the past year, AVB stock has been punished too heavily. 9. National Storage Affiliates Trust, NSA. National Storage Affiliates is the 6th largest publicly traded self-storage operator in the U.S. That size makes it a unique value today. That's because the industry's largest player, Public Storage, PSA, plans to acquire the No. 4 player, Life Storage Incorporated, LSI. Life Storage shares have run up about 50% this year amid the M&A excitement. With consolidation coming to the storage industry, National Storage Affiliates is the next logical takeover target if further mergers occur. National Storage is one of the smaller players, but has grown rapidly in recent years and could be a nice tuck-in acquisition for a bigger rival. 10. Realty Income Corp. O. Sticking with REITs, there's Realty Income. The firm smartly labeled itself the monthly dividend company many years ago and has attracted a loyal shareholder base that loves the REIT's large and frequently increased monthly dividend payouts. Realty Income is able to deliver its consistent results because it is a triple net REIT. In this structure, tenants, rather than the landlord, pay key expenses such as utilities and maintenance. With inflation on the rise, the triple net structure shelters landlords from rising costs, which have hit property owners in other segments of the REIT market. While Realty Income's business model is stable, shares have fallen over the past year as investors have indiscriminately sold off the REIT sector. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.